Thank you. Good morning, students. I'm sure this morning will be again adding a lot of value, lot of knowledge, and also lot of faith. Now, somebody will asking me, sir, from where faith would come between knowledge and the academic part. The answer is faith that yes, now I too am expertised in the subject. Faith that yes, now I too am able to understand, correlate, link the subject, and faith that yes, I'm going to stand out extraordinary in this paper, plus in my overall CA curriculum, and later on in my profession. So these things will be added today as we progress with the subject, with the topic. So yes, very, very good morning, Lingar. Good morning, Navneet, Ishwarya, Shamli, Tisha, Dhanlakshmi, everybody. Very, very, very good morning. Now, before I go to the topic of other sources, if you remember, we had this one part left, which is exemption under section 54. So I would like to start with this part first, that is exemption under 54, and then we will start with our other sources topic. The interesting part in other sources is that when you see other sources, you will find that in other sources, there are many provisions which has a linkage, which has a connection with other topics, other heads. Now, our previous class, we discussed the provisions relating to computation of tax on capital gain, where we understood that there are two types of capital gains, long-term, short-term. And for both these capital gains, there are two different provisions or two different categories for computing capital gain. Under long-term, you have section 112, which applies to all other capital asset other than 112A. And then you have 112A. In short-term, again, 111A is there. And then for all other capital asset, you have a provision. Now, what is the difference? If your asset is a listed equity share or a unit of equity oriented fund or a unit of business trust, and at the time of purchase and sale of such equity shares, you have paid STT, or at the time of transfer of the equity oriented fund units or business trust units, you have paid STT. In that particular case, your case would fall under 112A if it is a long-term asset, or 111A if it is a short-term asset. So for both these sections, the asset, underlying asset which is sold, which is transferred, and the conditions are same. Only if the asset is long-term because of its period of holding of more than 12 months, you will follow 112A, which is long-term. And if it is not, you will follow 111A, which is for short-term. Now, in both cases, capital gain is calculated in the same manner. So full value is the sale price. Importantly, the precondition of both these sections is STT is paid. Now, STT is an expense that you pay whenever you enter into any transaction on the stock exchange of buying or selling. However, important point is whatever STT you have paid at the time of sale, that is transferring these shares or units, that is not allowed as deduction. That is an express disallowance. Important point is cost of acquisition. Now, if the asset was acquired before 1st Feb and it was transferred today, then this particular provision of cost of acquisition will apply. You will understand this will never come in the case of 111A, because for 111A, the asset has to be short term. So it means it is acquired just within 12 months and sold. So definitely this point of cost of acquisition is not applicable. So if your asset is acquired before 1st Feb, then the special provision applies. If your asset, that is the shares, are acquired after 1st Feb, you will take the actual cost. If it is before 1st Feb, you will take higher of actual cost and this amount. What is this amount? This amount is lower of the FMV of these shares on 31st January 2018 compared with your sale price, that is FVC. Whichever is lower, and this amount compared with actual cost, whichever is higher, that becomes your cost of acquisition. Now let us say after adjusting this cost, the final long-term capital gain is 2,40,000. What is important under 112 is there is a specific exemption, if I can use this word, of 1,25,000. So 240 minus 125, this is the balance amount which will be considered as the taxable amount. Now, importantly, in your computation of income, you will be including 240 only. This 125 will not be subtracted at the start. So once you have computed capital gain and you are computing your total income, in that 240 will only be considered. Understand this? So 240 whole amount will be considered. From that, you will do your set off of losses wherever applicable. You will find out your GTI, that is gross total income. And only when you are finally computing the tax liability, at the time of computation of tax liability, you will subtract this 125 to get the final amount on which the tax rate will be applied, which is 12.5%. If it is 111A, that is the same assets, but period of holding is less than 12 months, so it is short term. Computation remains same. Whatever is the amount of short-term capital gain, which will be called as short-term capital gain under 111A, on that the tax rate applicable is to be applied again at the time of computation of tax. If it is any other asset, then the short-term capital gain is computed in the regular manner and the tax will be applied at the regular slab rate. If it is 112, we have already studied this computation earlier when we were doing understanding the computation, where if it is land building, assessee is individual HUF and it is acquired before 23rd of July 2024, you have the option of indexation and applying two rates. If not, then it will be done in the regular manner as we have been calculating the capital gain, and the tax rate applicable to long-term capital gain shall apply. So here we had studied this computation of 112. That is how computation of capital gain will happen in case of section 112. So this is how you do computation, where indexation option is available. After indexing whatever is a capital gain, you apply 20%. Where indexation is not applicable, you apply the regular rate of 12.5%. So this is all about computation of capital gain and the tax liability on capital gain. All this we studied in our previous class. Now the last part that we have to study today, so that our entire topic of capital gain will be concluded, is we call it as exemption under 54. Now there is not only one section, there is 54, 54B, 54D, 54 EC, 54F. Actually, there are many more sections, but I'm only writing down the ones which are applicable to you here. Now, please understand, students, that there is also something called as exemption under section 10. So there are two exemptions with respect to capital gain head. One is section 10 exemption, one is section 54 exemption. What is the difference? Section 10 is a section which covers exemption for all heads of income. So when you would have studied this chapter, and you would have also seen the application of this chapter in especially the salary head, because there you had done many computations of salary after applying section 10 exemptions. So these exemptions under section 10 are to be applied on the basis of the eligibility requirement of section 10, which means if you satisfy the respective conditions given under the respective clause of section 10, like in case of salary, section 1013A for HRA, section 1010 for gratuity. So there were multiple sections under 10. Those were various clauses of section 10 under which specific item of income was given exemption subject to conditions, subject to some computation. So section 10, you can say, exempts the income at its source itself. Means once the income is earned, if it fits in any of the clauses of section 10, you know there is exemption. 54 is slightly different. But before I come to 54, in our capital gain chapter, we have studied only one exemption belonging to section 10 category, which was section 1037, where what was the source of income? It was capital gain arising on compulsory acquisition of your agricultural land, which is in a specified area. First important thing, this is not a rural agriculture land, because had it been rural agriculture land, there was no question of going to section 10. There would be no capital gain applicable at the basis itself. Why? Because rural agriculture land is not a capital asset. But if it is a urban agriculture land, it is an urban agriculture land, and it is in specified areas where the government is taking up some public utility projects like expansion of roads or creation of 6-lane, 8-lane highways, or maybe setting up bullet train tracks, etc. Those are the specified areas. And if you are a farmer where you have used this agriculture land, then you were eligible for exemption under 1037. This we studied already in our previous classes. Now, besides this, there are no other exemptions under section 10 applicable to you. Whatever are few more exemptions that is applicable at final level, because those concepts of capital gain are applicable at final level. Now we come to section 54 exemption. As you can see, there are many 54 sections applicable. But before I go to a particular section from our module, I would like to give you an important input relating to 54 exemption. Now, what is again the difference between 10 and 10 exemption and 54 exemption? Under section 10, if something is exempt, it is exempt at the source itself. What do I mean by exempt at the source? So this is, let us say, one of the situations covered in section 10 exemption applicable to capital gain. Now, this is exempt at the source itself means that if you are satisfying these conditions, that your agriculture land is in specified area, you are individual HUF and a farmer, and it is compulsorily acquired. If all these conditions are satisfied, then you know that your income is exempt at the start itself. No need for doing anything else, no need for doing anything specific. Whereas under 54, in order to get the benefit or exemption of 54, you have to do something specifically. What is that something specifically? For this, let me just start with one of the cases. So let us say these were the different cases that we studied in our previous class. Now, you first compute the capital gain up to this point. So you follow or apply your working full value minus expenses, minus cost of acquisition, minus improvement. You come to this point, which is your final capital gain or loss. If at this point there is a capital loss, no need to go to 54 because you don't need to do anything to get exemption. Anyways, it is a loss. But the moment you get that, yes, it is a capital gain. Like if you remember, in all these cases, we studied capital gains of different scenarios and of different assets. So two things were covered in all these cases. One, different assets were covered. At some places, it was unlisted shares, listed shares, land, building, jewelry, gold, work of art. So different assets were covered and different situations were covered, like cost of previous owner when it has to be taken, or advance forfeited, or asset acquired in one of the modes which is not transfer, or asset acquired before 2001. All these different situation scenarios were covered. Now, after completing the computation, you reach at this stage where there is a capital gain. Here, you can subtract this exemption. I'm writing 54, it may be 54B, ECD, whatever. But to subtract this exemption here, we have to study the provisions. But before I come to the provisions, I'm giving the practical feel so that you can connect with the theory. So once you have reached this point that you have got your capital gain or loss, now you go to 54 to first check whether you are satisfying the eligibility criteria for 54. See, for any exemption, be it 10 or 54, you have to always first check the eligibility criteria, because for every exemption, there are some specific eligibility criteria given. Only when they are satisfied, you are eligible for exemption. But here comes the difference between 10 and 54. If it is 10, once you satisfy the eligibility criteria, you are exempt. You don't have to do anything specifically. But if it is 54, once you have tested that, yes, I have satisfied the eligibility criteria, my this case is eligible for one of the 54 sections exemption. Now I have to do something specifically. What is that something specific? I have to reinvest. What is the meaning of the word reinvest? See, already you are having a capital asset which you have sold or transferred today. So already there was an investment, let us say in shares, in land, in building, anything. You sold it. Now they want that if you want this exemption of 54, utilize your money to purchase another capital asset. That is why the word I'm using is reinvest. So they want you to again invest this amount which you have received on transfer of the asset. And once you utilize this amount by purchasing a capital asset, another capital asset, or let me use the word new capital asset, because what you sold is old. So let me now use original asset, which is for the asset which you have sold, or the old asset. And let me now use the word new asset or the reinvestment asset for the asset which you are purchasing only to be eligible for this 54 exemption. So once you reinvest the amount, now what amount has to be reinvested? In majority cases, it is this amount, the amount of capital gain that you have derived here. Still, as we progress, you'll realize that in one or two sections, it is a different amount, but generally, the general rule is what you have to reinvest is this amount. So once you reinvest, right, and the reinvestment is done in the specified time limit in the specified manner, you will get this exemption. So first you have to check eligibility. Are you eligible for this exemption? Eligibility boxes are ticked. Then second thing you have to do now specifically is reinvest. Again, for reinvesting, there are some conditions, time limit, manner, etc. Tick those boxes. Boxes means you have satisfied those conditions. Yes. Now you get exemption. Again, what is exemption? What are the conditions? What are the eligibility? Everything will be studied. But let us say, to give you the practical feel first, as per the section, out of the capital gain which you are getting of 67 lakhs, after applying all the provisions, reinvestment, everything, exemption is 60 lakhs. So you subtract this, and then the final answer of taxable capital gain, which is 7 lakhs. And this amount of 7 lakhs will be taken here in your final computation of income. So in your computation of income here, you will take this amount of 7 lakhs, which is your final taxable capital gains. I hope this is clear to everyone, students. Yes, any doubts with anyone relating to this? Yes, students, anybody, any doubts? Should I proceed? I think this was 2 lakhs, right? Yeah. Okay. Yes, Navneet, I remember what is pending that we'll be taking up in this manner as we have the time permission. But don't worry, we'll cover it. Now, this is the practical part. So after you reach this point of computation of capital gains, as we saw in the previous class, then you have to come to the last part, which is 54. Check eligibility. If eligibility is there, then follow the steps of reinvestment. Once that is done, you can subtract it here and you will get your final amount, which will go to the computation of income, right? Now, there is one more interesting point in 54 is whatever exemption I have given here, which now you can subtract to reduce your capital gain. If you default in future, this exemption can be taken back. So today I'm giving you exemption, which means I'm reducing your capital gain. I've done that. But again, with some more conditions or with some more restrictions, what you should not do in future. If you do any of those things in future, whatever amount I gave exemption today will be taken back. And when we say it will be taken back means this 60 lakhs in my present example, which is subtracted, which is reduced from your income, which is going to finally reduce your taxable income and tax liability. If exemption gets withdrawn in future, this will again be treated as income. So exemption withdrawn means whatever exemption you are getting today, because of which your income and tax is reduced, that exemption will be taken back, will be withdrawn, which means you will now have to pay tax on this 60 lakhs again in the future. This is what is withdrawal of exemption. Now we'll study all these things. So whenever you are doing 54, as I said, the first step is eligibility. Now in eligibility, I'm putting down some pointers. You have to go by these pointers. If you go by these pointers, you will never make a mistake. So in eligibility, you have to check which asset is sold or transferred. So there are specific exemptions for specific asset transfer. So why somebody would know, have a question, sir, why so many sections? Because for different assets sold, there are different sections. Like if you are selling your residential land building, you have section 54. If you are selling your agricultural land, you have 54B. If it is industrial land building, it is 54D. If it is any other long-term capital asset, any other means long-term land or building, but not necessarily residential only, any long-term land building long-term, it is EC. So for different assets sold, you have to select different sections. So first see which asset is sold, and depending upon the asset which is sold, you have to select one of these sections because each sections are dependent on which asset is sold. Now, it may happen that you have sold an asset for which there is no exemption. So that is also fine. It is not that every asset is given exemption, but more or less for individual HF, majority of the assets are covered. Now starts with the main question. Who is eligible for exemption? Who means whether individual, whether HF, whether firm, whether company, whether all. So who will get the exemption? Now for this, I'll give you some golden rules. I've already given you golden rules earlier for capital gain, understanding capital gain working. Now I'm giving you golden rules for section 54. Let me just change the color of my pen. Let me then first write the questions with this. So these are my questions for which I'll be giving you golden rules. In fact, these are the main points which you have to test, check, apply when you are trying to get or claim exemption under 54. Which color should I use? Okay. So first, you will check which asset is sold or transferred. Now, first question, who gets the exemption? Who is given the exemption? The answer is, will this be too light? Let me change, because maybe afterwards if you're taking a screenshot, it may not be visible. How is this writing? It is same color, no difference. Just wanted different from red, because red we have already used. Black we have already used. This is black. This is black. Check. I'll use purple. Now, who is eligible for exemption? Now, see what is my golden rule. Person who uses the asset. So, what are our steps? You first see which asset is sold. That will decide which section to apply. 54, 54B, D, EC, etc. So, which asset is sold, that decides the section that you have to read. Now, let us say I have sold residential land or building, which is covered in 54. So I need not check any other section further. I'll only limit myself to 54. Now in 54, you have to first check the eligibility. Eligibility is up to here. So up to here, eligibility provisions are there. Now in eligibility, the first question is who will get the exemption? Answer is the person who uses the asset. Now residential land building is used by whom? Who will require residential land building? It will be definitely people who will reside, who want to stay in that. And who are the people who have the requirement to stay? It is individuals or HUFs. So, important point is that 54 exemption is given to those who will use the asset or who are using the asset. This is my golden rule. So I'm giving you an example, like 54 section covers residential land building. So who uses residential building? It is individual HF. So 54 exemption is given only to individual HF. 54B is for agriculture land. Who does agriculture in India? Again, individual HF. So 54B exemption is given to individual HF. So first is Mithili, if I'm pronouncing your name right. Mithili, beta, you'll get answers to this. So whatever is your questions, people have posted withdrawal means what, previous exemption. So I think you'll get your answers. I'm using these terms. Once we take 1-2 examples or 1-2 sections as we proceed now, you'll get the answers. Yes, Kuldeep, you'll get answer to this. Everything you'll get. So please understand the rules first. So who gets exemption? The answer is person who uses the asset. Second, what type of asset, whether long-term or short-term? So here, general rule is your asset has to be long-term. However, if you remember, in entire capital gain, you should have exceptions. So here in some cases, short-term asset is also allowed or eligible for exemption. But otherwise, the general rule is exemption is given only to long-term assets. Then, most important, reinvestment in what type? So you have to reinvest in which asset? Again, the rule is so the question is now this exemption is purely or entirely based on reinvestment. So the question will come reinvestment in which asset? So where you have to reinvest? The answer is reinvestment in same asset. Same means You have sold an asset for which I have given an exemption, like our first point was which asset is sold. So you have sold residential land building. So you have to reinvest in residential land building. Again, there will be some exceptions. That is okay. General rule I am giving you. Then comes the next question. How much amount is to be exempt? So the answer is maximum, or I'll say not maximum. How much amount is exempt? The capital gain or amount reinvested, whichever is less. So if you satisfy all conditions up to here, that is the eligibility conditions, once you satisfy, how much will be exempt? So it will be capital gain that you have got from the computation or the amount you are reinvesting now, whichever is earlier. Next question is, when will this exemption be withdrawn? If this new asset is sold within 3 years. So आपने नया asset purchase किया, मैंने आपको exemption दिया, but then you should not immediately sell it. So let us say there is some lock-in period. Till this time, you should not sell the asset. If you have sold the asset within the lock-in period, then whatever exemption I had given you, that will be taken back. And how this exemption, which is taken back, will be taxable, that we will see. So these are the golden rules. Now here, one more question can be added. This reinvestment should be done in what time? But I have not added it here. Why? Because there are multiple answers in that कि आपने reinvestment कब तक करना चाहिए. So to avoid confusion, I have not added. But these are the general questions. So once you proceed with this exemption in this manner, answering these questions one by one, your answer will always be perfect. And as I already showed you the practical point, once you check the eligibility, once you satisfy this condition, simply this amount, capital gain or investment, whichever is less, that you have to subtract. That's it. This is how exemption under 54 is applied. So I hope you all understood the basis of this. Once you understand this, yes, Nagaraja betas, that is why I have not written the reinvestment period here, because the reinvestment period is different for different sections. So to avoid any confusion, I have not taken that question here, Nagaraja. Right? Yes, Harsh. So the answer is 3 years is your lock-in period. So you should not transfer or sell the new asset within 3 years. If you sell it within 3 years, I will take back the exemption. So it should be sold after 3 years, then there is no problem. Good question, Balamurgan. So Balamurgan is asking, sir, the requirement is that this new asset should not be sold within 3 years, which is the lock-in period. Now he's asking, sir, whether if I gift the asset within 3 years, or if I give it by way of inheritance, whether that will trigger my withdrawal. The answer is no, because the words used in the section are transfer. So they say that your new asset should not be transferred within the lock-in period, which is generally the 3 years period. Now, when they use the word transfer, we have to go back to the definition of transfer, Balamurgan, which says transfer means this, but it will not mean this, which is 47, which we say that transactions which are not regarded as transfer. So if your asset is given by way of gift or under will or under inheritance, in that case, the exemption should not be withdrawn. But good point, beta. Is this clear to all students? So if you understand this, the golden rules which I have given, understanding the provisions is now only like fill in the blanks. Okay, what asset is sold, what asset is purchased, who gets exemption, what period, how, because all that is already given. Now, nothing new you are going to study except 1 or 2 points. Fine. So if you understand this golden rules, And you know the exceptions to the golden rules, that where these rules, whatever I've written, have exceptions, nothing is left in 54. And I have already shown there is no special working when it comes to 54 exemption. There is no working. It is simply you have to subtract the amount of exemption here. That's it. That much is the only practical part in 54. Correct? So with this background, let us go to the questions. But just I want you all to click this. In the previous class, we had clicked all our theory part, whatever I had written in 2 or 3 parts. So I'll request everyone to please click this. This will be the last theoretical part. So you'll have screenshots of all the provisions which I have handwritten in my this notepad. In the previous class, I made into 3 or 4 parts. So everything was covered. So this is the last part. I want you all to click. Fine. Let us proceed. Now, see here you have detailed provisions, but I'll suggest you'll once read that detailed provision, and I will be taking you through the same thing from our let us recapitulate, because over there it is given beautifully in the form of a table. And it is very interesting to understand it and remember it from here. But I want you all to read the whole provision once at your end so that you will get it. Mithili beta, that will be answered, no? 7th point. Don't worry. That is kept blank, that you'll get the answer. So now what are the applicable sections for us? 54. Now, as I said, the first point is which asset is sold, that you should remember. So it is residential house. For residential house, the applicable exemption is 54. Then for urban agriculture land, the applicable section is 54B. So I'm on my first point of golden rule, which asset is sold. Now here, why they have used the word urban? Let me tell you students, if you read the act, there is no word urban given in the act. Act only says agriculture land. But why they have written urban, I'm sure by now you'll understand. Because even though the act has not used the word urban, but you will require 54B only if urban agriculture land is sold. Because if you have sold rural agriculture land, anyways, it is out of capital gain because it is not an asset. You need not come to exemption. Also within urban agriculture land, I'll just add one point. Other than the one which falls in section 1037 exemption. So if you remember today, that is why I revised 1037, because 1037 is the only exemption applicable to us at the inter level. And in 1037, what is exempt? You had urban agriculture land. This urban agriculture land was compulsorily acquired by the government because they were going to undertake some project. So if your urban land is in specified area means where this project is going on, and for that project, the government has compulsory acquired your agriculture land and you are a farmer doing farming over there, then it is exempt under 1037. Again, since this source is exempt, you need not come to 54B for reinvestment because it is exempt at the start itself. Arun Sagar, you will get the answer. Yes, Nagaraja, you're right. Have patience. Have patience. You're right, beta, but have patience. Now, next is when 54D, you have to check when the asset which you have sold is part of your industry. What is that asset? Land or building? So in short, the plot and the industrial structure. I'm not purposefully using the word building because whenever we say building, you see the buildings or what comes in front of your eyes is the building that you see around you. Here it is industrial building. So we construct industrial building and it is constructed on that piece of land. So if you're selling the industrial land or building, then what is applicable is 54D. But interestingly, again, 54D is not applicable when you are selling it by your choice, but when it is happening by way of compulsory acquisition. So if your industrial land building is compulsorily acquired by 54D, by government, you come to 54D. Now somebody will say, sir, but I have not, my industrial land building is not compulsorily acquired. I have sold it by my choice. Why? Because I want to shift to some other place. I want to shift my industry to some other place, some other city. Then for that also you have exemption, which is under 54G and GA. So same thing applies here. So what is sold is your land, building, plus here there is one more asset, plant, machinery, forming part of your industry. And now this is applicable when you have sold it by your choice. But this is not part of your syllabus, but just to complete your knowledge. So here 54D applies when your industrial land, building, and here plant and machinery is not covered, is compulsorily acquired. But if you are selling it by your choice, then also there is exemption under 54G GA, which is not part of your syllabus, but just to complete your understanding. Now, what was covered in 54 was only residential house. What if your property is either residential or commercial? So if it is residential or commercial both, it will come in 54 EC. So what is covered in 54 EC? Now 54 EC requires land, building, or both. Which land, building? Either residential or commercial. So interestingly, you will realize that for selling residential house, you have two exemptions which are applicable. 54 also and 54 EC also. So when you are selling your house, you have two choices for getting exemption. One is in 54, one is in 54 EC. Now, what is the difference further that we once we proceed further, I'll explain, because you need to keep in mind. See, you have to keep in mind 54 like this, that if I'm selling this asset, what exemption I can get? Because in exam, it will be very simple, the working part. I've been saying this from day one. The working part is the most simplest in capital gain chapter. But how to find out the amount to be filled in the working format is requiring a lot of skill. Again, there is no computation. There is no special working in entire capital gain chapter. Only there will be small working in this 54F. That's it. Other than 54F, there is no working at all in entire capital gain chapter. You have to only select. That is where you require a lot of remembrance, lot of clarity of provisions. But for the purpose of 54, how you have to keep in mind the provisions, you need to know for which asset, which exemption is applicable. So that is how I'm giving it to you. In fact, that is what I'll be writing on my notepad also, which maybe you can later on copy, that you should keep in mind for which asset, which exemption applies. So for residential house, you have 54, 54 EC. Now, interestingly, 54F will apply to what? It will apply again to any long-term asset, but now it is saying other than residential house. So interestingly, please pay attention. All these assets, urban agriculture land, industrial land building, or commercial property, all are covered in 54F. So 54F covered all your previous assets also, except residential house. So you can say nearly every asset has two exemptions, one specific and one general. I hope you understood this. Correct? So for every asset, you have some or the other exemption. 54F indirectly covers all asset when it says any long-term capital asset except residential house. Anyways, for residential, you already have one specific section. Hiram is asking, sir, if I sell my urban agriculture land and buy a rural agriculture land from that selling amount, yes. No, it won't be tax beta, Hiram. You have a very good point that you'll understand when we come back to the details of 54B. But you have a very good point. Answer to your point is no, it won't be taxed. Why? That you'll get the answer as we proceed. So I'm going by the points which I have given you in my golden rules. Point number one, which is you have to keep in mind for which asset, which section applies, because the section of 54 depends upon the asset which is sold. Now, once you know that what I have sold is, let us say, agriculture land. So you know I have now two sections for agriculture land. One is its specific section 54B and one is the general section 54F. So if I'm selling agriculture land, I have two choices. But before you proceed further, the most important point is who will get the exemption, which is my golden rule number 2. In fact, from there, our main golden rule starts. So who gets the exemption, which is my point number 2 in my golden rules? I have given you a golden rule. The person who uses that asset. Now see, who will require residential house individual HF? Who does agriculture individual HF? See, there are other people also who requires house, like even in a factory or even in not factory means even if a company is there or a partnership is there, their balance sheet may also show residential house, but they themselves, like a company itself, is not using residential house. It cannot, because it is an non-living person. So my golden rule, which I have given you, means who actually uses that asset. So who will actually use a residential house, either the individual or the family. Similarly, who is doing agriculture in India? Majorly it is individual or HF, that is the entire family. Now, here comes industrial land or building. Now, who is running industry? It can be any person. Who runs industry? Any person. It can be individual also. In fact, more you'll find that industries are run by companies or by partnership firms and less by individual HF. But even individual HFs are running industry, the smaller industries, and bigger industries are run by companies, etc. So it is applicable to all. Similarly, when you are saying any land or building, any land means residential also, commercial also. Residential, I can agree, it is only individual HF, but commercial land building again used by everyone. Everyone who is doing a business will require a commercial property. Now, this everyone can be a company, this everyone can be a partnership firm. So again, who gets the exemption? The person who uses the asset. And then this last 54F, it is for any long-term asset other than residential house. Why this is limited to individual HUF? Because interestingly, here what you are selling is any asset, but when you proceed further to find out that where you have to reinvest, then it says you have to reinvest in residential house only. So because this 54F is made for those persons who are selling their jewelry, who are selling their shares, that is any other asset, but buying a house, that is they are selling those assets to buy the house. That is why 54F is there. So again, by the logic of our golden rule, this section is made to buy residential house, and who will require residential house? Individual HF. That is how this condition comes. Correct? Is this fine? So you have to understand the golden rule. What is the first golden rule? First means in the sequence it is second, but from here our golden rule starts. Who is eligible? The person who uses the asset. Now you are given some conditions for residential house when you will be eligible for exemption under 54, where such house is chargeable under the head HP. In simple words, what it means that your residential property is not used for business, because if any property is used for business, it is covered under PGBP head. So it should be used for residence only. This is what impliedly this condition is. For agriculture land building, the condition is you will get this exemption if you have actually used it for agriculture. Means it should not be an idle agriculture land. You are actually doing agriculture for at least 2 years. Similar condition is here for industrial land building, when you will get exemption when at least for 2 years you have actually used that place for your business. That is, you are actually running industry over there for minimum 2 years. And for 54F, now please remember, 54F is made for whom? Those who are selling any other asset to buy a house. Now for this, the condition is this person who wants the exemption, obviously this person means the individual HUF, will get exemption under 54 if either he or she is not having any house at all, or he or she should not own more than one house. So either no house or you are already having one house. Interestingly, when this section had come originally, this one house condition was not there. So 54F was giving benefit only to those who were not having house. They were staying in rented house, and now by selling their other assets, they want to buy a house. Later on, this section was amended whereby either you are not having any house or you are having one residential house, but you want to buy the second house. So for both people, this exemption is applicable. The condition only is that you should sell any other asset like jewelry, gold, commercial property, shares, any other asset, and reinvest it in house. Right? Now, my third golden rule is what type of asset? That, if you remember, I had given that it should be long term. Interestingly, you'll find that long term condition here, 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 but not here. So, for two cases, the condition that the asset should be long term is not there, right? This becomes the exception. So, this is how you'll remember. So, our condition is the asset should be long term. I'll write exception. Two sections are exceptions. 54B, that is agricultural land, and 54D, industrial building, which is compulsory acquired. So for these two assets, the condition that the asset should be long term for getting the exemption is not there. For all other assets, it is there. Yes, Navneet, you can say so. 54D and EC is applicable for all assessees, but I'll have a different understanding. I'll say that you go by our golden rule, it is easy. So the person who uses the asset will get the exemption, but you can also keep it minded like this, like how I've written exceptions over here, Navneet. You can similarly write exceptions for the second point of my golden rule, that the golden rule is it is individual HF, but exceptions are 54 DEC where all assets or all assets are covered. You can keep it in mind in that way also. Mustafa, you'll get the answer, beta. Just allow me 2-3 minutes more. You'll get the answer to your question. Now, Now comes my second question or my second golden means next golden rule, which is point number 4 in my golden rule sequence. You have to reinvest in what? Here they are calling it as qualifying asset. My question is you have to reinvest in what? What is the answer which I have given you in my golden rule? The answer is same asset. So what you have sold residential house, purchase the residential house. What you have sold agricultural land building, purchase agricultural land, not building, sorry, agricultural land. What is compulsorily acquired is land or building of your industry, purchase land or building for industry, right? So what is our golden rule? Same asset. See, so here they have given in point number 4, you should reinvest in what they have called it as qualifying asset. Here they are saying residential house. Here they are saying land, which is for agriculture. Here they are saying land or building, which is for industry. However, again, our point number 4 rule has two exceptions where what you are reinvesting in is not the same asset. In 54 EC, what you have sold, long-term land or building, but what you are reinvesting in is some other asset, that is bonds. In 54F, what you have sold is asset other than house, but where you have to invest, you have to invest in residential house. So again, I will write this as my exceptions. So in all other sections, you have to reinvest in the same asset. However, for two sections, 54 EC, 54F, you have to invest in some other asset. It is not the same asset. Now, students, what is important is these golden rules, whatever I have given you, they apply in the same fashion at final levels. At final levels, when you will come, the sections, if they remain the same, they are not amended by future budgets, then you'll have the same sections, plus you'll have some additional sections. See, you have to remember that in all these chapters, especially PGBP, capital gain and other sources, you have many provisions which we are not studying here. Why? Because they have been kept exclusively for the finals. So if you observe, majority, whatever you are studying at inter level is from the perspective of individuals HF. At finals, you have individual HF plus everyone, trust, company, partnership firm. So here we have excluded those provisions which are from the perspective exclusively of a partnership firm or exclusively of a company, exclusively of a trust or a cooperative society. Because our inter syllabus, if you see your module starting point, it says it applies or it covers individual HF taxation mainly. So see, wherever I have given you golden rules, my golden rules are not designed only for this level because they are designed for that chapter. So even at final level where more sections will be added, this golden rule or rules will be same. What will only change or not even change, what will only expand is like I have written some exceptions. In exceptions, I have written two sections. Maybe one more section will be added. That's it. Why? Because that section is not covered here. So obviously, I'm not giving you in the exception list also. That's it. But the golden rules will not change at all. They will remain the same. Okay. Now, if you see here, I have circled something. What I have circled is something which is important and also which is to be kept in mind specifically. Now, what is this? Now, in 54, you have to reinvest in the same asset, which is the residential house. In 54F, you are selling any other asset, but investing in residential house. Now, here in both sections, where you have to invest in residential house to get the exemption, the law has specifically required that you invest in one residential house only. Means for getting this exemption, you should not invest in two residential houses. However, here we will study that there is an exception where two houses reinvestment is allowed. What is that exception? This exception. So, see this. So in this section itself, two residential house investment is allowed. But what is the condition? Now, obviously, this is interestingly an option because the original section was that you should invest in the single residential house. But I'm giving you an option. Now, for this option, what is the condition? The condition is that your capital gain has not exceeded 2 crores. So if your capital gain amount that you have got is up to 2 crores, then you are given a choice that you can invest in two residential houses. But what is very important that this option only once in lifetime. You have this option only once. Once means see, residential house, today you have sold, you have purchased another residential house. Maybe in future, you'll sell this and purchase one more. So you may be purchasing and selling residential houses in your lifetime twice, thrice, four times. But this option that you can invest in two houses for exemption is allowed only once. So the first rule is only one house you should purchase. This rule has exception that two houses are allowed, but the condition is this option of investing in two houses allowed only when your capital gain has not exceeded 2 crores. And second point, this is allowed only once in your lifetime. Clear? Understood? Here, there is no exception. Here, only one is allowed. In case of 54F, here the option of investing in two, etc. is not there. So you have to invest only in one residential house. Perfect. Now comes the next point. This is slightly what you have to keep in mind. Now I am eligible because I'm individual. What I've sold is a long-term residential house. And in order to get exemption, I need to reinvest again in residential house. I've understood it up to this point. Now, my point is this reinvestment should be done within some timeline. What is this timeline? Now, this is the golden rule which I have not written, or I have not taken this point in my golden rule, because you'll see there are different rules for different assets. So that you'll have to take effort and keep in mind. Now, what is the timeline given for making this investment? The timeline given for the residential house, here also you have to purchase a residential house, correct? Now, why I've written this? Because for both, in both cases, here also for exemption, you have to purchase a residential house. Here also for exemption, you have to purchase a residential house. For both, the timeline is same. What is the same? If you are purchasing, you can purchase 1 year backward or 2 years forward. Purchase 1 year backward, 2 years forward. But if you are constructing, it has to be 3 years forward. Now somebody will say, sir, what is this backward? What is this forward? I'll explain. So I'm giving you example of section 54. What I have sold is my residential HP in Mumbai. I've sold it today, right? So I've sold it 13th of January 2026. Now, in order to get exemption under 54, I should purchase another residential house. Let us say this is in Delhi. Up to what timeline? So for purchase, they are saying 2 years forward or 1 year backward. 1 year, 2 year. So from the date I have sold this house, Mustafa, pay attention because this was your question. Not, sir, not your question. This was whose question? I think Arun Sagar's question. So for the purpose of getting this exemption, I have to reinvest. How I'll reinvest? I will purchase another house. Now this another house, either I should purchase 1 year back or 2 years forward. Now what it means? From the date I'm selling it, what is my date of sale in this example? It is today's date, 13th of Jan 26. Either before I'm selling this house, I should have already purchased a house that is 1 year backward. So maximum or here. So either before sale I've already purchased, which is 1 year back, or after sale I'm purchasing in future, which is 2 years forward. So whenever they are saying before and after, I'm using the word backward or forward just for simplicity. For both sections, the condition is same because in both sections, what you are going to reinvest is in a residential house. Only the difference is in 54, what you are selling is also a residential house, whereas in 54F, what you are selling is not a residential house, it is any other asset. So only the name of the asset sold is changing in 54 and 54F, but reinvestment in both sections is to be done in residential house only, and both sections have the same condition. Now, interestingly, this backward condition, if you see, is very critical In fact, in case of residential houses, in 90% scenario, it will be backward only. I repeat, in residential house, in 90% scenario, it will be backward only. I'm sure you understand why. Because residential house is such a thing, which is your basic necessity. So until and unless you purchase a new house, in 90% cases, you will not sell your existing house. So many times what people do is that when they want to sell their existing house, they first they book a house. They in fact do the interiors, they shift there and then they sell this house. Otherwise, it will be a challenge. Yes, there are people who may first sell it because they are getting a good option. They sell it first. They may shift to some temporary accommodation or rented accommodation, and then in future they buy the house. That is a scenario. But majorly it will be backward, right? But when you see transfer and reinvestment and how the reinvestment is by way of construction, for construction, they are saying it has to be only forward. So how you are getting this new house? You are getting this new house by way of construction. Then it is only forward. So for construction, backward option is not there. So in case of construction, the reinvestment will be only forward, 3 years. So the timelines are purchase 1 year backward, 2 year forward, construction 3 years forward. Now this is only for 54 and 54F, where what you are purchasing is a residential house. Now, when we come to agriculture land case, you have to reinvest within what time? Within 2 years forward. There is no backward. And obviously you can understand there is no construction involved. So there are no two timelines of 2 and 3 years. When it comes to industrial land building, here they are saying whether you purchase or construct, because here there is land and here there is building also. Now land will be only purchased, building can be either purchased or constructed. That is why it is slash. So anything what you have to do is 3 years forward only. Again, there is no backward. It is 3 years forward. Most important point, all these timelines, backward, forward, right, which was, I think, Balamurgan's question, will be calculated from which date? Sorry, Arun Sagar's question. All these timelines of forward, backward will be calculated from the date of this original assets transfer. So that's why I have written the dates for your better understanding. So if I've transferred the asset today, the original asset, then the timeline of 2 years back, 2 or 3 years forward or 1 year backward will be counted from this date of transfer. So the date when you are transferring your original asset, from that date, you will check the timeline. So Neeraj, it means backward means you have purchased the house first, the new house first, and then you are selling the existing house, which is the original asset. That is what it means. And the new house should have been purchased within 1 year of sale of this house. Or other way around, you have purchased a house and after purchasing the house within 1 year, you have sold the old house. You have to keep it in mind like this. But practically, because the sum will come with respect to the house which is sold, so you have to see the sale date, go 1 year backward from that date. Fine, Neeraj? Now, when it comes to 54 EC, where what you are selling is any land building, but what you are investing in is bonds. Now, bonds are such things which do not require time. Why? Because bonds are like shares. You have to simply go to the market, the online portal, wherever these bonds are listed, and you can buy them directly. So here the time limit is only 6 months forward. So for 54 EC bond, they've not given you 2 or 3 years timeline because that will not require time. Buying shares is today so simple. It is just a fraction of some, or it is some minutes that requires to buy a share. Similarly is bonds. Correct? Understood? Now, coming to my next golden rule, which is if I satisfy all the above criterias, eligibility criteria, and if I have satisfied all the requirement that I should reinvest in the same asset, the reinvestment should be done within the timeline. If I satisfy all this, then the question comes, how much is my exemption? Right? Mustafa, now here pay attention. It was your question if I recall. So exemption is, I've given you the golden rule, which is not applicable only here. In 54F, there is some special point. Otherwise, the golden rule is, how much is my exemption? Exemption is the amount which I have invested or the capital gain, whichever is less. So either it is the cost of the new asset or the capital gain which I have got, whichever is lower. Same. Cost of the new asset or my capital gain, whichever is lower. Cost of the new asset or my capital gain, whichever is lower. Capital gain or the amount invested, whichever is lower. Now, let me give you examples. Capital gain, I have got 50 lakhs. First option, how much is my reinvestment? Reinvestment is 40 lakhs. So I have not invested the full capital gains. I have invested only some part of it. Now rule is whichever is lower. So I'll get 40 lakhs. Second option, I've reinvested 65 lakhs. So I've invested more than the capital gain. So I've got 50 lakhs, but I've invested 65 lakhs. Then whichever is less, how much is my exemption? It is 50 lakhs. So the calculation of the amount of exemption is simple. It is the amount of capital gain which you have got in your working or the amount given as reinvestment, whichever is lower. Nagraja, sir, in case exam trapping question asking and given distance plus population, how to identify rural versus urban? What is the problem, beta? See, you have to remember a population, Nagaraja, right? Depending upon population, that is 10,000 to 1 lakh, 1 lakh to 10 lakhs, and about 10 lakhs. They have given you 2, 6, and 8 kilometers. So you have to remember that. And then depending upon what population is given, you have to see you have to recall the kilometers limit which is applicable, and accordingly you will apply. Right, Nagaraja, means I did not get what is the concern. Are you just informing or you're asking a question? Because what you have said is a simple statement that itself is the answer. Oh, oh, such a big name. How to pronounce your name, beta? Kambir, Kambira, Kajana, Rasima. Oh, okay, Kambira is better. Yes, Kambira, I'm pronouncing correctly, right? So, Kambira, see, your question is what if assessee is unable to make investment? That'll come. That is a specific point, Kambira. That'll come. Yes, Navni. So, this is exactly the point I'm telling Nagaraja. So my point is Nagaraja, what whether he said was a statement or a question, that is what I did not get, because what he's saying is like an answer. You have to apply two things, the population plus the distance to identify whether your land is in urban area or rural area. Now, Mustafa, I hope you got your answer here that when it comes to all these sections except 54F, if you are investing part of your capital gain, like here, out of 50 lakhs, you invested only 40 lakhs. So exemption is 40 lakhs. So it is very simple. My simple answer, which I've given in my golden rule also, is whichever is lower, right? But when it is 54F, it is going to be interesting. Now this rule, how much is exempt, is having again an exception, and the exception is 54F. Now what is this exception? To understand this exception, I'll give you an example. FVC 100. Expenses on transfer is Okay, let me take some. So my net consideration is 98. Now my cost of acquisition plus cost of improvement, right? Let us say comes to 48. So the capital gain which I am getting is 50. Now, before 54F, all other section says you have capital gain of 50. You want exemption, you have to invest up to 50. If you invest up to 50 or you invest more than 50, you get full amount as exemption. But 54F is slightly different. Now, under 54F, my exemption is not linked with the amount of capital gain, but my exemption is linked with the amount of net consideration. Now, what is the exemption? The working is capital gain multiplied by reinvestment upon net consideration. So there is a proportionate working. Now, when this working becomes important or critical, so here in all other sections, they want you to invest the capital gain amount. So you have to invest up to 50 lakhs. But 54F says that you have to invest this amount. So if you have invested up to your net consideration, your full capital gains is exempt. In other words, to get exemption of 50 lakhs, which is the capital gain, you have to invest 98 lakhs. This is the simplest logic. In all other sections, to get exemption of 50 lakhs, you have to invest 50 lakhs only. That you have to invest the capital gain only. But here in 54F, to get exemption of 50 lakhs, which is your capital gain, you have to invest net consideration, which is 98 lakhs. Now, if you have invested 98 or more, no problem, entire 50 lakhs is exempt. But you have invested less. Let us say instead of 98 lakhs, you invested only 80 lakhs. So I wanted you to invest 98 lakhs, but you invested only 80 lakhs. So your capital gain will be exempted proportionately. So instead of 98, you invested 80. So my capital gain will be proportionated. So this 50 lakhs capital gain will not be allowed full. You have invested 80, but you are supposed to invest 98. So this is how your exemption will come. I hope this is clear to everyone. Yes, students? Yes, somebody is giving me amount. Mithili beta, net consideration means full value, that is a sale value minus expenses on transfer. In my example, it is there, no? Full value, that is the sale price minus expenses on transfer. Correct, students? So yes, people have given me answer. Nagaraj, I'll answer, but wait, that question is interesting, or that will require some sort of understanding. So allow me some time, I'll answer. So out of 50 lakhs, 40.81 lakhs is exempt. So my taxable capital gain is 9 point. So this is how 54F is different. But there is one more point in 54F. So besides this, there is one more point. So I'm just putting L. So all figures are lakhs, rupees in lakhs. Yes. Perfect, students. Very good. Now, there is one more point in 54F. Now, 54F says, oh, sorry, 54 and 54F both. That is again, what is common in both? Both are dealing with investment in residential house. They have kept a upper cap of 10 crores. For what? For the cost of the new house. So for the cost of the new house, they have kept upper cap of 10 crores. Which means what? That if you are investing above 10 crores, we will not consider it. So the maximum amount that we are going to consider while computing exemption is only 10 crores. Now somebody will say, sir, what it means? I'll give you an example. So same thing, 100 lakhs, I change it, it is 100 crores, 2 crores, 98 crores, 48 crores. Now here your capital gain is 50 crores and you have invested again 80 crores. But here the working will be 50 crores multiplied by 10 crores upon 98 crores. Even though your reinvest is rupees 80 crores. So here same, it was in lakhs here. Here the same is in crores. You have reinvested 80 crores, but what I will consider is only 10 crores because 10 crores is the maximum limit of reinvestment for the purpose of exemption. You can invest any amount, but I will consider up to 10 crores only when I'm computing my exemption. Now, there is no why. See, there are certain things which are as a policy, but still I'll tell you why. Because they do not want to give benefit to super rich. Super rich are the ones who sell assets where the houses were already in crores, like in posh areas of Mumbai, Bangalore, Delhi. The houses are running in multiple crores, and you get entire exemption by reinvesting again the multiple crores. So to restrict the benefit to super rich, they have got this limit of 10. Just allow me 1 minute. Okay, is this clear? So yes, Mustafa, when they are saying amount exceeding 10 crores will not be taken into account. So this is what I have shown you practically. So in this example of mine, you have reinvested how much? You have reinvested 80 crores, right? But what does the section says? Amount exceeding 10 crores will not be taken into account. So you have seen I have only considered 10 crores. So if you are reinvesting above 10 crores in the working, you will take up to 10 crores only. This is what this point means, that in calculation only 10 crores will be considered. Yes, Mustafa. So that is why I gave you this example so that you understand this. इसमें दे पानी है वो तो जस्ट वो गिरा रही थी इसमें मैंने understood Mustafa beta. So when the language says that amount exceeding 10 crores will not be taken into account, so what it means, see, I'm giving you practical theory, it is there in front of the screen, but what it means practically you'll get it from this example. Similarly for 54, we simply do comparison of capital gain or the amount reinvested, whichever is lower. So if you have reinvested more than 10 crores, you will consider only up to 10 crores for comparison. So let me explain. Again, see, I'll give you example. So here I've taken example of 54 exemption, right? Now, what was my example? 50 lakhs, 40 lakhs, 65 lakhs. Let me convert it to crores. So capital gain is 50 crores. Now you have reinvested how much? 40 crores and here 65 crores, two options. Now when you are comparing, if you have invested about 10 crores, even though you have invested 40 crores for comparison, you will take 10 crores. Even though you have invested 65 crores for comparison, you will take 10 crores. And this amount will be compared with 50 crores to find out whichever is lower. So in this case, your answer will be 10 crores in both cases. Understood, Mustafa Beda? Understood by all? Are those sections applicable to compel? It is applicable to all cases, Arun Sagar. So when we are talking about 54 or 54F, they have not put a condition. It simply says your residential house is transferred. So whenever they say transfer, it is applicable to all. So other than 54D, all others are applicable in all scenarios. In all the scenarios that we have studied in the previous class, whether it is sale, whether it is barter, whether it is compulsory acquisition, whatever, all cases are covered. But for 54D, 54D beta is applicable only when the asset is compulsorily acquired. Yes, Harsh. So if you have invested more than 10 crores, like in my previous example of 80 crores for 54F case, you will consider 10 crores in that proportionate working. Here now in the present case, again in 54, this present case on the screen is of 54. Here also you have invested 65 crores or 45 crores, but for comparison, you will take maximum 10 crores. So maximum 10 crores is the limit for 54F comparison. Similarly, in 54 EC also, there is a maximum limit of 50 lakhs. So when you are comparing your amount of capital gain with amount of exemption to find whichever is lower. So what is our rule? What is exemption? Exemption is capital gain or amount invested, whichever is lower. Amount invested has to be up to maximum 50 lakhs in case of 54 EC. And in case of 54 and 54F, it has to be up to 10 crores. So in short, you can say this is your maximum limit. Aditya beta, 10 crores is taken firstly for 54 and 54F workings of exemption, and it will be taken whenever your investment amount in the new asset is exceeding 10 crores. So if your investment amount in the new asset is below 10 crores, then whatever amount invested that you will consider while calculating exemption. But if the amount of invested is exceeding 10 crores in these two sections, for the purpose of computing exemption, will take 10 crores. Aditya. Mustafa is saying, so sir, first we have to know who is assessee, correct? No, first you have to know what is the asset. Go by my sequence. Which asset? Because that asset will decide which section. And then when you go to section, in that sections in conditions, the first condition is who is the assessee. So first is what asset is sold. On that basis, you will check who is the assessee, what should be the type of asset, then investment in what asset. So go by my sequence, which I have given. Arun Sagar, sir, there is condition like capital gain amount need. Array Arun beta, I will come to that point. Arun, wait, my explanation is not complete. Allow me some time. If I explain everything at once, for y'all it will be clean bold. 160 kilometer Yorker, clean bold. Right? So that should not happen. So I'm giving you firstly full tosses, then I'm giving you simple short pitch balls, slow balls. Then slowly, steadily, I'm giving you in swinging Yorkers or in swinging balls. Allow me some time. Correct? So, how to decide amount of exemption, capital gain compared with amount invested, whichever is lower. For 54F, there is a proportionate working. And then in this, the next point is for two sections, 54 and 54F, when you are computing the exemption, the amount of investment which you are taking for comparison, that is limited up to 10 CR. So if it is above 10 CR, in your working, you will take 10 CR. And 54 EC, this amount of investment is limited up to 50 lakhs. Correct? Understood? Clear to everyone? No doubts? Yes, Nagaraja. So in exam asking googly, na? So we are preparing for that googly also. Googly is your exceptions. So what is googly? It is exceptions. Correct, na? So this is what is the straight ball or the regular ball. So I'm doing a leg spin with this action. And with the same action, the ball instead of leg spin becomes off spin. That is what is the exception. So you're right. Now, so these are the provision students. Now coming to the main point or the point which some people wanted to know. But before that, I'll come back to my now. When will this exemption be withdrawn? I am calling it as the lock-in period. So the rule is I have given you exemption, and for that I've asked you to purchase a new asset, which we are calling it as reinvestment. Now, this new asset you should keep with you for a minimum period of time, which is 3 years in all cases. And again, there is an exception to this where the period is 5 years. But again, general rule is you should keep the new asset for 3 years. That is up to 3 years. You should not transfer the new asset. Correct? Is this clear? Now, what will happen if you transfer this new asset? Then the rule says whatever exemption I had given you, so what does the law says? That if you are selling the new asset within 3 years of its purchase, the exemption will be withdrawn. But for withdrawing the exemption, what we will do? What is firstly meaning of withdrawing exemption? It means the exemption which was already allowed will now be taxable. How it will be taxable? Since you are selling this new asset within 3 years, I will reduce the amount of capital gain from the cost of acquisition of new asset. Now, interestingly, if you're reducing the amount of exemption from the cost of acquisition, so what will happen? Now, your new assets cost of acquisition will reduce. And if it is reducing, automatically the capital gain which you are getting on this new asset will increase. But I will not deliberate more because it is not covered in detail in our module at this level. So only for your knowledge, I'm informing you again. See, these points are not covered in detail, but just for your knowledge purpose, I'm adding. Now I come to the last point, which was question of two, three students. First, I think latestly who asked, uh, I think Arun Sagar asked, then somebody else had also asked. Now, what is this point? Pay attention, students. With this, we will complete and close capital gain and we'll go to other sources. Now, this point is dealing with the time limit of investment. Time limit of reinvestment. Now, I purposefully not given this as a golden rule because we saw it is 2 years, 3 years forward. In some cases, it is 1 year backward. And in some cases, it is 6 months forward. So there are multiple timelines. So I've not given it to you as a golden rule because there will be more exceptions than the rules. So I've not given. But I'm not interested in this timeline. This we already studied, whatever is the timeline. Now, what is a practical concern? Understand this with this example. The simplest example I have taken, that is of this rule. 13th of January. So I'll write it here. Now, I have sold original asset on 13th Jan 26. Now, if I'm given this time limit of 2 years for purchase, I should purchase it by 12th of Jan 28. And if I purchase it by 12th of Jan 28, I have satisfied the condition, I am eligible for exemption. This is what we have studied till now. But there is small challenge, there is small problem. What is this problem? This 13 Jan, that is today's date, is falling in previous year 25-26, for which due date under section 139 for filing return of income is 31st July 26 or 31st October 26, as the case may be. Now, interestingly, now see the contradiction. The law has allowed me a very far off date to purchase the new house, which is ending on 12th of Jan 28, which is 2 years from this date. But the challenge is this year's capital gain, whatever I have to compute and pay tax, has to be done by my due date of filing of my returns, which is coming immediately. So I'm selling the asset today in January. My due date will fall either in July or in October. I will not get the 2 years timeline. So loss is 2 years, in some cases even 3 years, which is even farther date, but I'm taking example of 2 years. And I'm just writing section also so that you will be able to relate. So my asset is the residential house property, section 54 I'm talking about, where for purchase forward you have 2 years. Now there is a self-contradiction in the law. At one side, you are saying that this current year's return has to be filed by 31st July, 31st October and pay tax, which will come immediately. July will come in next 6 months, October will come in further 8-9 months. But you allow me time limit farther. Practically, I will never be able to get this time limit. Please understand this. So then what is the use of this time limit? Because for this year's income, I have to pay tax up to July. Until July, my 2 years is not getting over. I have not purchased the new house. Then the question is, you have allowed me a further date that even if I purchase up to January 2028, exemption should be allowed. But practical problem is in this year's return, which I'll be filing in next 6 months or 8-9 months, how I will take exemption because I have not purchased the new asset because it is allowed by you. So here comes the point. What is the point? The point is you have to do investment by this date only, because by this date your return will be filed, your taxes would be paid. So by this date you have to do reinvestment. What? Either in the new asset. So either I should purchase the new house by this date. Now I'm taking the example of house. It can be agricultural land, it can be industrial land building, whatever is the asset. So either I purchase the new house by this date, but then if you are compulsoring me to purchase the house by this date, then what is the use of that 2 years, 3 years timeline? Or they say if you want to utilize this time limit of 2 years for purchasing the house, still by this date you have to do something. What you have to do? Deposit in a special bank account under capital gain deposit scheme. So by the due date of filing your returns, whatever it is, either you purchase the new house, matter is closed, or you deposit the money in the capital gain deposit scheme, which is a special bank account open in SBI. Now, if you have gone for the second option, then today we will compute your exemption. How we computed exemption? Capital gain or investment, whichever is lower. For the purpose of investment, we will consider this amount of deposit as investment. Though you have not purchased the new house, but this deposit amount kept in the bank will be treated as your investment because that amount you have invested where? In the bank. So today, in today's return, we compute your exemption by taking that deposit amount as reinvestment. Now what will happen? Now you get this 2 years timeline, or if you want 3 years, 3 years timeline. Within that timeline, purchase the new asset, construct the new asset. If you have purchased or constructed the new asset within the timeline and you have utilized this deposit amount, matter closed, chapter closed. But what if within this 2 years or 3 years timeline, this amount deposited was not utilized? Now, interestingly, if you understand logically, I had given you the exemption with the precondition that you purchase the new house or land, agricultural land or industrial land building, whatever. But if you fail to do that, if you do not invest in the new house, but you had done deposit. So because of doing deposit, in the returns, I have given you exemption, but you fail to reinvest, what will happen? This exemption will be withdrawn, will be taken back. And in the year in which this time limit of 2 years, 3 years is over, I will tax it. It will be treated as income of that year. Second possibility, I have purchased the new house, but I have not completely utilized the deposit money. In that case, the shortfall between the purchase cost of new house and the amount of exemption which I had given you in your returns on the basis of this bank deposit, I have given you some exemption amount compared with the new house cost, whichever is lower will be taxed as income. So this is that point for which two students had asked me a question. Now I'm explaining it, and now I think it will be digestible, understandable. Still, I'm sure there will be some confusions, but that it will take time. See, certain provisions are very tricky. Certain provisions are, like I said, now 160-kilometer fast Yorker. So you may get or require some time to understand, adapt. Navneet beta, you are saying in study material for slum sale, it is 36 months. If you recall my lecture, I had corrected it with my hand from 36 to 24 months. So kindly make that correction, beta. Fine. Navneet is again asking, sir, slum sale ke liye long term, short term. I think I just answered your question, Navneet. Then Nagaraja says 24 months. Yes, Nagaraja, you are right. Fine. Can we use both indexation and 54? Arun Sagar, beta, indexation is gone. Indexation is over. Only in one specific case, you are having indexation, but that also at the time of tax computation. Now, today, Arun Sagar, if let us say you are going for that option of tax computation, that will be done at the end. Today, for exemption of 54, you will take the value of capital gain, which is before indexation only. This is what is very important, that when you are computing 54 exemption, and let us say later on you are going to take the option of indexation, which is now limited in very specific case, for that also your amount of capital gain will be the amount which is before indexation, because now your capital gain working is all without indexation only. So students, with this, we complete the entire capital gain. I know it may still take time at your end and it should take time. If anybody says I'm through with everything, so maybe your this understanding that you're through is not complete, because when you'll actually read the section, when you'll actually see some practical question on that, you will get confusion, which is, see, understand this at this level. You cannot assume that somebody has taught you something and you have understood something. That assumption is defective. Your correct way of understanding, or when you have actually understood, is when you have solved the questions relating to that, which may be theory, practical, MCQ type. And in that question, in whatever scenarios were given, when you find the answer, either your answer is correct at the first go, or at the first go it will be wrong. Why? Because when I've explained something, you have understood it in a particular manner. You have created some picture in front of your eyes of that provision, which may be wrong. That is okay. Correct way of understanding, or what is the correct way of knowing that you have understood, is after today's session, go through the practical sums all given below the module, plus the practical sums in past exam questions. Okay. Somebody will say, sir, there are amendments. So don't go very far back, just go 1 year, 2 years back. Even if there are amendments that you will understand, or if not, in the next class, first 15 minutes, 20 minutes, or even 30 minutes, I will be only taking your doubts, because the best and the correct way of getting knowledge is only after resolving your doubts. So please be ready to solve. Please be ready to get doubts and get confused. Why I'm saying this? Because I've seen many times students are under a different uh, mindset. They want to get everything right the first time. Let me tell you, this will never happen at professional level, especially in such complicated topics. This is one such concept. It will be there in every subject and at every level. So please don't carry the mindset that I should get right everything first time. If not, then you lose confidence. If not, then you lose interest in the subject. That is the worst approach. And if anybody is guaranteeing you that you will get everything through first time, that guarantee comes with some riders, which they may not be telling you, like how it happens in sale of many products. They first market everything positive, but there are some riders which they do not mention, or mention very fast. Mutual funds are subject to market risk. Take your all of yourself. This is said very fast so that you don't pay much attention. Please be ready to get confusions. Please be ready to get wrong answers. Please be ready to get jumbled up between two provisions. That is the only correct way of reaching the knowledge, correct knowledge, complete knowledge. For that, you have to solve. So take out time. You have time. You can come back to me in any lecture asking the doubt of this chapter or any chapter. It will be answered. Correct? Fine. Nagaraja is saying, sir, if house is purchased in spouse's name, Nagaraja, beta, why you are going to such extents immediately? See, there are so many ifs and buts. But beta, if I give everything immediately, na, it will be confusing for everyone. But still, if you have asked me question, I'll answer. It is allowed, because the law has not said that the investment should be in your name. If it is in your nearby family's name, there are judgments which says it will be allowed. Is this clear? Rashmi beta, it is 24 months only. It is a typo error. I will inform BOS to get it resolved as early as possible. So don't worry, beta, it happens. 36 months. Shraddha beta, please don't depend on Google. I don't depend on Google for answers. I depend on the act. You go to the act. That is why I make you read the act many times by going to the website, right? So please, there is a typo error which will be resolved very soon. And Google, I never refer to Google for these things. And please remember, the day Google starts giving you right answer, you will be out of market. So I'm happy that Google is giving you 36 months. Fine, beta. Okay. So students, we have completed. Now, not we, I have completed. Your side capital gain is left. That will be done only when you solve all the questions and when you get answers wrong and you get it clarified from me. Now I'll just take 10 minutes break. It is 8:51 in my watch. We will resume at 9:01 to start with other sources. Fine? Just 10 minutes break today. Neeraj is asking, even if, sir, if I purchase house from somebody and after some weeks I sold my house to that person, so we both get exemption under 54 because no, beta, you will not get, na, Neeraj. Why? Why you will not get? Because that person sold house to you. Firstly, it should be long term for that person. I am assuming it is long term. You purchase the house, and if you sell it back to that person, what I have understood. So I purchased a house from somebody, and after some weeks, I sold my house to that person. Now, in this particular case, if you are selling different houses, so he sold his house, which is, let us say, house A. You are selling after some days house B, that is okay. But first possibility, you're selling the same house back to him, right? You will not get exemption. Why? Because same house will not become long term. Second, you are saying, so we both get exemption under 54 because we both invested. So, except where it is the same house, if it is another house, let us say you already had one house, you sold that house to him, he sold his house to you. So, yes, it is a cross transfer. There will be exemption, but I don't think this is a loophole. Why it is not a loophole? Let us say, I'll give you a practical scenario. It is barter, means I've sold my house to you, and instead of the amount coming to me in money, consideration coming to in money, you sell another house, another means your house to me. So it is a barter, my house against your house. So it is very acceptable. But understand this, even if let us say you are considering this as a loophole. Firstly, for me, there is no loophole because both are selling one house and both are buying another house. Point number one. Point number two, how much percentage of such transaction will be there in all the transactions happening? Not even point 0.1. It will be even below point 0.1. See, because it is such a rarest of rare possibility that I am selling my house, you are selling your house, we both connect to each other. Point number one. And point number two, we like each other's houses. So this is a very rarest of rare possibility. But still, even if I consider that, so far as the houses are different, you sell house A to me, which is your house, I sell my house B to you. And let us say we enter into a barter transaction. No tax to anyone, but there is no evasion. Correct? There is no evasion, beta. I don't consider this as a loophole or evasion. Anyways, other sources. Now, when I'm going to other sources, I've said this earlier also, and I'll repeat. There is one very big misunderstanding, like how I mentioned for capital gains also. Here also, there is one very big misunderstanding. Hmm, where should I write? Shall I write here itself? What is the misunderstanding that we get when we are studying this? That all receipts not falling in any other head will be other sources. This is not correct always. Means what? That anything that you are getting, and if it is not covered in salary, HP, PGBP, CG, it becomes other sources. This understanding is wrong. Then what is the correct understanding? Firstly, check whether it is income under section 2 clause 24. So firstly, it should be income. Secondly, this income is not covered under the remaining four heads. Then only when both these conditions are satisfied, it is taxable. Correct. But interestingly, besides this, there are some specific receipts which are also taxed under other sources. What are those that you will study under the charging section 56 bracket 2? So what is the point that I want to make it? Many times we understand or we got this impression, if I can say, that any receipt that you are getting has to be taxed. So firstly, let this be clear. Any receipt that you are getting need not be taxed always. Why? Because that receipt has first got to satisfy the concept of income as given under 2 bracket 24. Only then you decide that it is taxed under which head. So first you have to cross 224. Now let us say your receipt is fitting under 224. It means it is income. Now comes the next point. The next point is check if any other four heads, the first four heads, is specifically covering that. If it is covering that, you have to go there only. But if it is not covered there, then you should know that it will be other sources because it is firstly income. Obviously, when I'm saying check 224, also check section 10 because it should also not be exempt under 10 because if something is exempt, then again, there will be no taxability. But yes, still, even if it is exempt, it will fall in some head. That is why I did not refer section 10 earlier. But you have to keep in mind, ultimately, you will pay tax only if it is not exempt under section 10. Now, interestingly, there are such receipts which are specifically said to fall under other sources. Why I'm emphasizing on this? It means other sources is not only a residual head. It is a residual head, I agree, as per the first point we discussed. But there are some receipts which will fall in other sources only. It is given in the law, for example, dividends, for example, interest. But there are some receipts where you have to first check if it is falling under HP or falling under PGBP or falling under capital gain. And if not, if those chapter does not cover, then by the residual approach, it will fall under other sources. Correct. So majority of receipts or incomes of other sources is of residual nature only. But there are a few specific receipts like gifts or some specific items. In fact, I'll tell you one interesting point. Wherever the government has found that some income is escaping assessment because it is not getting covered under four heads, they have designed this specific or they have used this specific receipt rule to cover it under other sources. So that is how the specific receipt rule came. That wherever the government found that there is some loophole in some other act, not act, other head, because of which this receipt is not getting taxed, they have specifically included it in other sources. So with this background, let us see. Now, when we come to format, the format of other sources is very simple. What is this format? Receipt minus eligible deduction. Eligible under section 57 and ineligible So what are eligible is given under 57, what are ineligible under 58. Obviously, you have to study both to find out what finally can be deducted. So receipts minus only those deductions which are eligible and excluding those deductions which are ineligible. So when you subtract from receipts the eligible ones, what you get is income under other sources. So here in format, they have first given list of items which will be treated as incomes, right? Now, many of these you know, some are new which we are going to study here. So firstly, you take the receipts and then from these receipts, you subtract those expenses which are allowed as deduction under 57. And while doing this, you have to keep in mind 58 also because it has restricted certain expenses. So something like PGBP, we have golden rules, 4 rules. So with the help of 4 rule, you first check whether it is eligible. Similar is 57. And then you have some restrictions in 40 clause A, 43B, 40A2, 48B, where certain expenses, even though eligible as per the golden rules, are still disallowed. Same logic is here. So there are expenses which are allowed, but then 58 also gives you some conditions or expenses which will not be allowed. Now, after this, you'll get your final income from other sources. Now, interestingly, tax rate. Again, when you have completed the entire computation and you have reached the tax calculation, similar to capital gain, in other sources also, some incomes have some special tax rates given, like winnings from lottery, betting, crossword puzzles, horse races, etc. There is a specific tax rate given 30%. Where it is some unexplained income, like something like you were trying to evade tax and later on it was found, so it is unexplained. We will discuss this in detail. The tax rate is 60 with surcharge also at a very heavy rate. Then online games winnings, if you are getting, then on the net winnings, it is again 30%. So both are winning, so it is 30%. But for online, they included the provision separately. So you are having a separate point here. And other than these three, all remaining incomes. Now, what are remaining? See this list. So dividend, then interest, advance forfeited, gift, compensation, life insurance premium, then incomes which come here because of the residuary rule, because they are not taxable under other heads like PGBP, HP. Again, the residuary rule, any income chargeable but not falling under any other head. So all these are taxed at the regular rate. So in our case, like individual HF, it is the slab rate. But these special incomes, that is winnings and the tax evaded income, which is the unexplained. These are the two types of incomes which have special tax rates. So winnings and the incomes which were evading or where you were trying to evade tax and later on you were caught and you were it was found and it is categorized as unexplained. These two have special tax rates. Remaining all incomes falling under other sources will have the regular rate of tax. I hope this is understood. This is clear to everyone. Fine, students. 50D may attract. For what, beta Arun? See, 50D is a topic of capital gain. 50D in capital gain applies wherever you are not able to find out the sale value. So how here you have said 50D may attract? For which point you are saying 50D may attract, Arun Sagar? Okay. So see, this is very simple. So as compared to other heads, understanding wise, other sources is simple. First, we will study what are the various receipts which are covered under this head, either by the specific rule or by the residuary rule. Then we will see what are some specific deductions which are allowed. We will see what are the expenses which are not allowed. Here you will get the feel of PGBP, because if you see what is covered over here is very much what you studied in PGBP restrictions. So like you can see TDS related restrictions. Then when you are making payment to related person and the amount is exceeding FMV, or you are making payment exceeding 10,000 and it is not made by the banking channel or the online channel. Same restrictions of PGBP. So restriction wise, nothing new we are going to study. So, okay, let us start. Now, method of accounting, if you remember, we studied this in PGBP also, because for both these heads, other sources and PGBP, for both these heads, section 45, which is the method of accounting, has given the assessee an option. You may follow cash basis, you may follow accrual basis. Again, this option is not available for few incomes, which are obviously exception to this rule, because those few incomes will be taxed only by the receipt method. But again, they are very few. The general rule for PGBP and other sources is that you are given a choice. You want to compute by cash approach, you want to compute by accrual approach. Now, we come to the charging section. Now charging section is 56. In 56, you have bracket 1, which is the residual rule, which I explained above, which says that if what you are receiving is income, and if that income is not covered in the other four heads, it will be taxed here. But then you have the 56(2), which is, I call it as the specific income rule, where they have given you a list and they have said that these incomes will be taxed under other sources. Now in this list, the first item, now you will see this 56(2). So this is the specific rule list, not the residual rule. Residual rule is 56(1). What does 56(2) cover? So the very first clause covers dividend. Now on the face of it, you will say, sir, okay, I know what is dividend, but wait. Under income tax, there is a very interesting definition of dividends given under section 2, clause 22. According to this, there are dividends which can come to you in 6 different manners. That is something very special. So what is dividend as per income tax? First is the money which is paid by company to shareholders as a part of profit share. Correct? So as a shareholder, you are owner of the company, right? After the year ends, the company closes its books, it determines its profits. And from that profit, since you are owner, you should get your share in the profit. So you are given this share, which I am calling it as part of profit, which is your share. How it is given to you? You receive the dividend amount through checks, or nowadays it is online, directly credited to your bank. So dividends in generally what we understand, or till now we were knowing, is the money coming from the company to its shareholder as a part of their share in the company's profit. Correct, man? This is the only thing which we know. However, this section 22 says that we will deem some receipts to be dividends. Now, why this section is there? First, understand what it is there. It is there in front of you and it is easy to understand. So till now, we were understanding that only money received by a shareholder from its company, that also given by the company at the end, calling it as distribution of their profits to the owners, that is shareholders, will be dividends. That is fine. But interestingly, what happened? This was also the understanding of Income Tax Act, no doubt. But later on, the government found that people started evading tax. How? They means now the companies, especially which are private companies where there are limited shareholders, and the limited shareholders are the ones who are running the company. So they are the management also and they are the shareholders also. What they started doing to avoid tax on dividends, the company started giving benefits to their shareholders, not in money form, but in some other form. This is where the income tax law decided to include those amounts also as dividends, and they have said we are going to deem, means we are not going to argue or fight with you that actually what you have given is dividend or not, but we are saying simply that we are assuming, so you have to accept, because we are law, I am law, and if I'm saying I'm assuming this is dividend, you have to agree to that. Now what all things they have assumed to be dividends is interesting to note. So first, where the company is giving away its assets. Second, the company is giving away its liabilities. Now the word uses distribution. What is distribution? In Hindi if I say बांट दिया. अब dividend भी company बांट ही रही थी, पर कैसे बांट रही थी? In money form. Now to avoid tax, they started doing what? They started they started doing what? Instead of giving money, they started giving away assets. Further, what they did, some companies, see, if a company is issuing its debentures, its bonds, it is creating a liability in its books. Now, what they did is smartly, instead of giving you money, they said that, okay, I will issue debentures free of cost to the shareholders. Now, when you issue debentures to anyone, you take money. Why you are giving it free of cost? Because that was another way of giving dividends only. See, these were all the ways how the company was trying to tweak the law to evade tax. So government said, no problem, I'll make a law like this only. So where the company issued its debentures, its deposit certificates, its bonds to the shareholders free of cost, and bonus shares to its preferential holders free of cost, then such distribution was also to be treated as dividends. Then, if at the time of liquidation the company is distributing, if at the time of reduction of capital the company is distributing. So these first four clauses were clear that whenever the company distributed to its shareholders, we will treat it as dividends. Now, what is very interesting to be noted is all these distributions should be made out of companies' accumulated profits. You will find this condition everywhere. Only where the company has accumulated profits and it is distributing any of these things, we will treat it as dividends. So, wherever the company had accumulated profits and instead of giving money, it gave assets or it created its own liabilities and distributed them, or at the time of liquidation. Now, see, at the time of liquidation, the equity shareholders account is created, if you remember any such case of liquidation, and in that we credit the equity share capital, plus we credit all the profits with P&L balance, general reserve balance, all the statutory reserves balance, everything is credited to the shareholder, and then the shareholder is paid. Now what this point is saying, at the time of liquidation I am paying you two things. Whatever I am paying out of share capital, that is not dividends in your hands. But whatever I am paying out of my accumulated profits, like general reserve balance, P&L balance, statutory reserve balance, that whatever I'm paying to you is going to be treated as dividends. Similarly, at the time of reduction of capital, now what is reduction of capital? Originally, when the company issued shares, it was of rupees 100. Now I am saying that I'm returning back some portion of this 100 to you. So the shares are of 100, but now they are rupees 50 paid up. Originally, I had paid 100 only. So originally, these shares were of 100, 100 paid up. Now what I'm doing is I'm saying I'm returning half of your money back. So these shares, which are of 100 rupees, will now become shares of 100 rupees, 50 paid up. They were earlier 100 rupees, 100 paid up. Now I'm reducing. How I'm reducing? I'm repaying you. I want to reduce my liability. Now, interestingly, as a shareholder, what you will say, I had given you this money 10 years back. In 10 years, utilizing my capital only, you have created so many reserves. So at the time of reduction of capital, I will not only take the 50 rupees out of my capital to reduce the capital, I will also take some share from reserves. So that is why again, clause or subclause D says that whatever the company is paying out of its accumulated profits, it will be treated as dividends. Now, see, in all these things, the law uses the word deemed. Why? Because maybe in the eyes of company, maybe in the eyes of shareholders, you may not consider it as dividend. That is your choice. That is why we are saying we are deeming. We are assuming that these dividends are taxable. Firstly, we are assuming these are dividends, and then we are saying these dividends are taxable. Now, in this second point, what is to be noted is where the company is giving away its debentures, bonds, deposit certificate, it can give it to any shareholder, be it equity, be it preference, and then within preference, cumulative, non-cumulative, participative, whatever, all types. But when it is giving bonus shares, if it gives bonus shares to equity shareholders, this is not dividends. But where only it is giving bonus shares to preference shareholders, it will be dividend. So this you have to keep in mind. So besides the condition of there being accumulated profits, what is the condition? That in case of distribution of shares, bonds, etc., if bonus shares are given to equity shareholders, that is not treated as dividends. Why? Because giving bonus shares to equity shareholders is acceptable. It is a normal in the normal course that companies do. But if the company is giving bonus shares to preference shareholders, that we will consider it as dividends. Now, besides these four, you have two very special cases of dividends, E and F. F is in fact added very recently. E was also added some times back, but it also was added later, not at the time of originally writing this definition. Now, why E and F are added? If you remember, I had mentioned this at the start, how these specific rules came. They have come to plug in some or the other tax evasion scenarios. Now, what income tax observed after 1961 when the VAT Act came into force, the income tax observed that many private companies, they are evading tax on dividends by not giving money. And also now all the above four clauses are there. So they're not giving assets, they're not giving their own bonds and debentures to the shareholders. Then what they are doing, they found that they are showing as advance or loan given. Who? Private companies. So this fifth part of dividends exclusively made for private companies, not for public companies. So where they found that private company is giving advance or loan to whom? One, either to the shareholder directly or to any other business in which this shareholder has substantial interest. What is substantial interest? Having 20% share capital. So let us say the company is giving loan advance to the shareholder himself or to a partnership firm. What is this partnership firm? It is started by this shareholder only along with other partners, and shareholders PSR is 20% or more. Or it is another company in which the shareholder's shareholding is 20% or more. Or it is any other entity in which shareholder shareholding is 20% or more. So either the loan advance is given to the shareholder himself or to any of the businesses of the shareholder where the shareholder has a substantial interest. So what are the conditions of this fifth type of deemed dividend? You are a private company which is called as closely held company, and what you are showing is you are giving loan or advance. To whom? To a shareholder or his business. But who is this shareholder? Is it to any shareholder? No. They are saying this loan advance is given to such a shareholder who is, I will call it as a major shareholder. Now, who is a major shareholder in the eyes of income tax? Who has beneficial ownership of 10% or more of your equity shares. So, whoever shareholder holds 10% or more beneficially, that shareholder is said to be a major shareholder. See, this word major shareholder is not in the law, but I'm giving you so that you can recall and recollect this section comfortably. So, a shareholder having 10% or more of your equity shares is considered to be a major shareholder. Now, if the company is giving loan or advance to such a shareholder, the company is a closely held, that is a private company. This loan advance is deemed to be your dividend. Again, the condition you should have accumulated profit. See, why this condition is always there? Because dividends are given only out of profits. If the company is not having profits, then none of these things can be dividend. So the company is having accumulated profits by whatever name. It may be capital profits, it may be revenue profits, makes no difference. It should be accumulated profits. So first, company is giving to shareholder or the company is giving to, as I said, business in which this shareholder has substantial interest. Now, this business is run by the shareholder. How? as a HUF, as a partnership firm, AOPBY company, in which the shareholder has substantial interest, which is minimum 20% in the PSR. Now, exceptions to this section. When this loan will not be considered as dividend, the answer is where the company itself is in the business of giving loans. So it is a banking company. Now, if it is a banking company and if the shareholder comes to the bank saying that, see, you're giving loan to the entire world, so give it to me also. I will also make application. I'll give you security deposit. So where the company is itself in the business of giving loans like a bank or an NBFC, then if it gives loans to its major shareholder, we will not consider it as dividends. Interestingly, what will happen if in future this company has actually given you dividends? So let us say in the present year, the company gives you 2 crore as loan. Firstly, we will treat this 2 crore as your deemed dividend in the current year itself when this loan is received. Assuming above conditions are satisfied, company is private and I'm having 10% or more in the equity shares. Now, after 2 years, the company actually distributes dividends of 12 lakhs. Now, when the company has given actual dividends in the money form of 12 lakhs, sorry, here it is crore, okay, I'll make it crore. Now, in this particular case, they say that in the future, when actual dividends are given, what I will do is I will subtract this deemed dividend. So in the future, what I will tax is only the balance. Why this is given? To avoid double taxation. See, 2 crores was actually a loan given by the company to you, but law is assuming it to be dividends. Fine. But if in future, if real dividends are given, then if you tax again that 12 crore, it will be unfair on the part of the shareholder. So here the law says we will subtract the earlier deemed dividends from the actual dividends because that we have already taxed. So we will only deduct we will only tax the difference, right? Now, some clarification that where the company has given you loan, and again, the company is not a banking company, so it means the loan will be deemed to be dividends. It makes no difference whether subsequently you repay the loan or the company is charging you interest at market rates. These things will not affect. In short, the moment a private company gives loan to its major shareholder, whether or not it is a genuine loan, whether or not it is carrying interest or securities given, we will not see anything. We will deem it as dividend. Only exception is where the company is itself a bank or NBFC, then only it will not be considered as deemed dividends. Otherwise, it will be considered as deemed dividends. Now the F point, which is recently added from last year, which we have already studied in capital gains. What is this? Where a company buybacks its own shares. Now, before this amendment, that is up till the last year, if a company has purchased its shares back from the market, which we call as buyback, which happens as per specific provisions of the Companies Act, then this buyback was taxed. So it was taxed in the hands of shareholder under capital gains, right? Up till last year. So why it was capital gains? It is simple because what shareholder has given, it has sold its shares back to the same company from which it had purchased. This was treated as capital gain, but this was up to last year. Then in last year's budget, same date, 23rd July, the amendment happened. And now what they are saying, the same buyback, if it is happening after 23rd July 2024, in capital gains, you will have capital loss equal to cost of acquisition of the shares. So as a shareholder, you had purchased these shares. So whatever is cost of acquisition of your shares will become your capital loss. And in other sources, amount paid by company will be deemed as your dividends. So you had purchased these shares for 100 lakhs. Company paid today 140 lakhs. Now what should have happened? If this would have been tax under capital gain, 140 lakhs minus 100 lakhs, 40 lakhs would be the capital gain on which you would have paid tax. This happened before 23rd July 24. Now from 23rd July 24 onwards, the 100 lakhs, which is your cost of acquisition, is becoming capital loss under the head capital gain chapter. And the 140 lakhs, which you are receiving as a consideration from the company, this entire 140 lakhs is treated as deemed dividends, right? So whatever is the sum paid by the company for purchase of its own shares will now be full amount of 140 lakhs is treated as deemed dividends. Yes, you're right, Rashmi. But I'm not purposefully mentioning that because then it will be too complicated. Um, Nee, Balamurgan, you do not ignore COA. COA is not considered as nil. Acha, there is some other question. Balamurgan is saying, is bonus share surrendered as dividend? In this case, on transfer, COA will be nil. Oh, see, when bonus shares become dividends in the hands of preference shareholders only, if these bonus shares are tomorrow sold, transferred, cost of acquisition will not be nil. Yes, Navneet, you are right. So the cost of acquisition in case of buyback, which we are discussing right now, will be short-term or capital loss, depending upon period of holding. So if these shares are long-term, the cost of acquisition becomes a long-term loss. If it is short-term, it becomes a short-term capital loss. Correct. Rashmi, we just have to check the date what you are mentioning, right? So students, this is what is the latest provision on deemed dividends. Now, what will not be treated as deemed dividends is first, distribution in respect of non-participating shares issued for full cash consideration. So any distribution made in C or D, C was what? Liquidation, D was what? Um, Reduction of capital in respect of shares issued for full cash consideration and the holder of share is not entitled to participate in surplus in the event of liquidation. So where the shareholder is not allowed to participate in the surplus, then there is no question of dividends. So in case of deemed dividends, in C and D, we were assuming that at the time of liquidation or reduction of capital, the company is paying you out of the accumulated profits. But if the share itself are non-participating, that is, the share itself says you have no rights in the accumulated profits, then in such cases, it cannot be deemed as dividends. Then loan or advances, which is between group companies. We know what are group companies. So within a company, if there are multiple different companies, which we call as sister concerns, then in loan or advance between two group companies, where one of the group company is a finance company or a finance unit, and the parent entity or principal entity of such group is listed on stock exchange in a country or a territory outside India, other than the country or territory outside India notified by CBDT. And last is distribution of shares at the time of demerger. So these are the three exceptions where this deemed dividend provision will not apply. Now, somebody has asked me this question above. I purposefully did not answer ki how dividends will be taxed. For this, you have Section 8, and Section 8 has made out two scenarios. One is interim dividend and one is actual dividend. For interim dividend, Section 8 says it will be taxed in the year in which the interim dividend is unconditionally made available by the company to the members. So in short, we say that in the year of receipt. Whereas the regular dividend is taxed in the year in which either it is declared or paid. So regular dividend tax, you can say somewhat on accrual basis. So even when the company declares it, may not be paid, it will be taxed. Or if it is first paid, it will be taxed. But interim dividends will be paid only where will be taxed only when they are actually paid by the company. Now coming to the new category, that is deemed dividends. Now for deemed dividends, which we saw above, when it will be taxed, the first four deemed dividends will be taxed in the year in which that asset, that liability is distributed by the company. Why? Because distribution of those assets liability was deemed to be dividend. So obviously they will be taxed in the year of distribution. Whereas in case of E, which dealt with loans, when will that loan be taxed in the hands of the shareholder as deemed dividends? In the year in which this loan was given by the company to the shareholder. So in short, you can say this is tax on receipt basis. So two things are tax on receipt basis. Deemed dividends, which is the loan, or the interim dividends. And what is tax on accrual basis? Regular dividends that you receive every year, which will be taxed when they are declared, or deemed dividends from A to 4, where the company is doing its distribution. What is the tax rate on dividends? We already saw above. There are no special rates for dividends. It is taxed at the normal rate. What is important is when we are talking about deductions. Now, we just saw above that some deductions are allowed, not allowed. Now, for dividends, there are some special rules relating to deductions. Unfortunately, it is not given here. So I'll go to the deduction point so that you can keep it in mind as a whole single point. So for dividends, there is a condition relating to deduction also. In short, everything is not taxable as dividends. There is some deduction, but that deduction has some condition, some restriction. Let me take you there. So what is deduction is given under section 57. Now in 57, again, the first deduction is relating to dividends only. Now here, recently the buyback point is added. So what it says, in case of dividends, but other than the buyback wala case. So for all other cases, what is the rule? Only one only one expenditure is allowed as deduction. What is that expenditure? Interest. So for investing in these shares, you have taken a loan. So the interest that you are paying against that loan is the only expenditure that you can deduct from the dividends, and that also subject to a maximum of 20% of the dividends received. So whatever is the dividends received, up to 20% of that you can pay as interest. This interest is the only expense which is allowed as deduction. No other expense will be allowed as deduction in case of the buyback wala case. So firstly, for all other cases of dividends, only one expense is allowed as deduction, that is interest taken for investing in the shares. For the buyback wala case, even that is not allowed. So for the buyback wala case, which is treated as deemed dividends, no deduction at all is allowed. So this is the whole point relating to taxability of dividends under the head other sources. We will stop over here, students. In the next class, we will cover remaining majority of the items which are taxed under other sources. And in the other class after that, we will complete by covering the remaining part. And if there is any practical point that has to be covered. Yes, Arun, tell me.
Sir, actually, I have a doubt. In a
Yeah,
liquidation, sir, if I'm a shareholder, I invest 100 rupees. It is example, sir. During the liquidation, the company given 500 rupees worth of the asset to me. In that time, first I need to deduct dividend. What are the part of the dividend related to me? It need to be charged under other section, income from
Correct.
other section. Okay.
Correct.
Sir, but that time remaining that if I charge to the capital, income from capital under it, I going to lose a deduction rupees, so 1,25,000 rupees.
Why you will lose?
Because I'm paying a capital gain difference amount.
See, in your example, you receive 500 from the company, correct?
Yes,
First, you have to apportion that 500 between dividends and between the capital amount, right?
yes,
How you will distribute? You have to go to the balance sheet of the company, see how much is the share capital and how much are reserves. Because
yes,
whatever is company giving to you is out of its share capital and reserve, right?
yes, sir.
Let us say when you see that out of your 500, 150 is treated as part from share capital and remaining 350 is treated as part from reserves. Fine.
Yes, sir.
This 350 will be other sources,
Yes, sir.
deemed dividend,
Yes, sir.
and this 150 which will go to capital gain. Over there, you will deduct the cost of acquisition of shares from there
Yes, sir.
because it is capital gain. So you have to deduct cost of acquisition of the shares and the balance will be taxed over there as capital gains. So what you are losing, I did not get your point. What
Sir,
is your
but
loss?
50 rupees dividend we going to charge under the income from other source.
350 is charged as other sources. Correct. So what is the challenge? I'm not getting your question.
Sir, okay, I'm missing 1 lakh 25 rupees in the if I hold a long term means under 112A. There is some
But better
exemption
see,
deduction.
you cannot say you are losing. How come you are losing? See, when 1112A would have applied, only when STT is paid, right? So you have equity shares, correct. But if those equity shares are not STT paid, then 112A will not apply.
But
But that has
initially I
nothing to
paid,
do with
sir.
liquidation. Na? In normal cases also, if you are selling the shares and they are not STT paid, then anyways 112A is not applicable. So you cannot say I'm losing that 125, 1,25,000 benefit because anyways the benefit applies only when the shares are STT paid. And why that benefit is given? Because your shares are already STT paid, so I'm giving you some benefit. Now here
Sir,
in case
but
of liquidation, tell me.
in case if I want, I can pay STD.
No, you cannot pay because in case of liquidation, now your shares are not traded on stock exchange because your company has already gone into liquidation. When STT is applicable, because see, STT is charged and collected only by the stock exchange.
Yes,
Now here you are directly getting the money from the company itself at the time of liquidation. So there is no question of STT. You do not have that option of paying under paying STT. STT is charged by the stock market,
sir,
correct?
but I read in test book, normally STT broker, they are not going to charge. We need to pay to security exchange directly.
So that's what I'm saying, na beta. Nobody is going to charge STT. See, I'll tell you how it happens practically. Practically, when you are selling these shares or on a stock exchange, like people are doing it daily on regular basis, when you sell it at the stock exchange, when you are getting the money, the stock exchange deducts the STT amount and pays you balance, right?
Yes, sir.
Means who has collected the STT from you, the company, correct?
Yes, yes, sir.
Now the point is, if in this case of liquidation, you are going to return back the shares to the company and the company is going to give you money. There is no question of there being any STT because your shares are not sold through stock exchange, correct?
Yes, sir.
So understand this. Why that 1,25,000 exemption is there? Because you have paid STT. Now here there is no question of STT. So why should I give you that exemption of 125? So that should not be a challenge, na?
Okay, sir.
I hope you are getting this.
Yes, sir.
So
Thank you.
not on in any case where STT is not paid, 112A is not applicable and 112A not applicable. So 125 is not applicable. Correct?
Yes, sir.
Fine. Any other questions, students? So we conclude here. Please solve sums from capital gains so that in the next class, if there are any questions, confusions, doubts, which can be there, which should be there, we will address it and we will proceed with our other sources. Thank you, Mustafa. Yes, I know there is a lot of information to process. That is why I always break it and give it to you in small, small parts. So thank you all. Take care. Study well, practice well. I want you all to become experts of this subject. This is a very beautiful subject, and both these heads, capital gain and even PGBP and even other sources, are practically the most important heads. In fact, people practice in these heads only. They're super specialized, right? Thank you. Thank you very much. Take care. Done, sir. Thank you, sir. Thank you, Manish. Take care. Bye.